What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 24th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I want to spend some time to dispel a lot of the FOMO and the uncertainty for those who are sitting on the sidelines right now around the Bitcoin $1 million price target, the hyperinflation theory that the banking system is going to collapse and everyone needs to run to Bitcoin as a safe haven. I'm going to talk about how you can hedge yourself in these situations, what's the right way to approach this potential probability, which is very unlikely, as I'll talk about later on. And more importantly, throughout this video, I want to spend some time to talk about the broader asset markets and how this is going to play an impact on cryptocurrencies as a whole. We've got a lot of things to dive into in today's video. If you guys can stick around, if you enjoy my rambling, consider dropping a like. It's one of the best ways you can support the channel. There's going to be a lot of juicy information in this episode, so stay tuned. You guys won't want to miss it. All right, let's go ahead and kick off the rambling, guys. I first off want to go ahead and bring back what we discussed in our previous videos, our kind of roadmap here for what we think Bitcoin is going to do, which is coming up into this range between 28K and 32K, which was the last kind of consolidation range, and holds a lot of important significance from the pullback in May of 2021, as well as the first mid-correction here in January of 2021 since the breakaway. Now, I want to go ahead and again emphasize here that that's what we think is going to happen. We think it's a relief rally. It's going to roll over and go back towards new lows or relatively close to the FTX collapse lows around 14, 15K. But I want to go ahead and just say, what if we're wrong here, right? I know a lot of you are asking the same question, and to be honest, it's always good to kind of be a bit of a contrarian on your own opinions and think, hey, what if we got this wrong, right? We don't want to miss the trend. We don't want to miss the upbreak. And we especially don't want to be caught empty-handed if the entire financial system does collapse, as some people are proposing. Now, I just want to go ahead and say one thing, guys, and this will go ahead and probably dispel a lot of the FOMO that a lot of you are feeling. If you feel that Balaji's potential theory is right here, and that Bitcoin is just going to go absolutely supersonic to the upside. It's going to go to 100K or more, and in fact may go all the way towards 250K, 500K, 750K, or $1 million, like he's claiming to be this multi-trillion-dollar asset in 90 days. All you got to do is take some of the cash that you have, some of the savings you have, and put 1%, 3%, 5% in Bitcoin, just a little bit, and you will have hedged all of your wealth. The problem I have here is that the broader Bitcoin community, and more specifically talking heads like Balaji that are getting a little too confident in their bets, they got to speak confident because the momentum's behind them now. They're saying and convincing you of the idea that in order to hedge your wealth, you've got to get your money out of the bank. You got to get it into Bitcoin. It's almost guaranteed. I put $1 million there. Therefore, it's got to be real. Don't listen to talking heads like this, guys, who tell you to do absolutely everything or you're going to lose all your money, right? Now, the only time you should listen to that is when you have people warning you about taking excessive risks that could lead you to lose your money, like leverage trading, things like we call out here on the channel. If people are telling you, though, that moving money out of a bank account is the most important thing you can do now because in the next 90 days, somehow the financial system is going to collapse. These are the type of really far out predictions that are emotionally driven by people who genuinely like Bitcoin as a technology, but aren't respecting you and the risk that you'd be taking by putting capital into an asset they are already well overexposed in. So you guys need to understand that here, that the people preaching that narrative do have a financial incentive. And on top of that, they face no repercussions if you get it wrong, right? And I think we need to go ahead and really step back into reality here. Something that unfortunately a lot of people are not preaching here on YouTube, on crypto Twitter, and the echo chamber, the bubble that crypto can be sometimes. Crypto, whether we like to think about it this way or not, had its best performance over the last decade when central bank monetary policy was good. And Bitcoin didn't act so much as the hedge that people thought it would be against some financial collapse, but rather was this amazing asset when there was increase in the base money supply that allowed Bitcoin to continue expanding year by year, generally having some harsh years along the way, but for the most part, having green year after green year, expanding and outpacing every single asset. Equities also did great during this period of time. Property values also did great during this part of time. However, crypto led the way. It was the fastest growing risk-on asset. It grew in a similar pattern to risk-on stocks like the FANG stocks, Nvidia, AMD, the different types of semiconductor stocks out there. You name it, biotech, all the things that were risk-on, high growth, accelerating during a period of optimism. However, Bitcoin, like other assets, is going through a period of time where the Fed can no longer rescue it with the kind of excess money it had in the past. And we need to keep that in mind when we're building our broader analysis. Let's go ahead and talk about some of the broader equity topics I want to discuss here. I want to talk previous market leaders, the technology stocks, the few that are still holding up quite well, and the narrative that people are driving around those stocks. And outside of that, I want to talk about the defensive stocks, because a lot of people say that, Nick, at the end of the day, isn't there still going to be some reason that we could break away? Are we seeing new market leaders? Are we seeing the potential for a new bull market? Because that's the ultimate question. If equities are not going into another bull market, it's going to be incredibly difficult for Bitcoin to be this kind of breakaway asset. And again, as we talked about, for the exponential case that Balaji is making, fine, have 1 to 5% exposure to Bitcoin if you want, guys. That's fine. But just understand and be willing to face that while it is serving as a hedge, it could roll over and you could face losses on that position of your portfolio. But hey, it may be something you just want to hold on to and you're willing to wait until you can sell it at a higher price. And you think it's worth it. It's insurance on your broader savings. That's fine. We're not here to argue against that. I'm talking about those who are traders who want to put the majority of their capital into certain positions. Now, we already can see here, if we take a look at the Vanguard Total Stock Market ETF here, the stock market has not been really signaling signs of optimism. Sure, it's at a higher price level than its relative lows back in October, but we are seeing that the higher lows and higher highs here are practically anything but. It's really weak since the trend we saw back in October and November. Since then, in January, we've really been fading towards lower prices since the end of January. We weren't able to get back where we were in August, so we're at a lot lower price point when the Fed came out and really laid down the hammer, and the trend is generally looking quite bad. So let's dive a bit deeper rather than just looking at the indices. The things we talk about in the Dash Report, our newsletter, and we also talk about here on the channel from time to time, really stepping into the macro perspective. One of the big things I want to talk about are the FANG stocks. Now, there is a very, very big underwritten issue here within equity markets that doesn't get talked about enough and is a typical sign that we have had massive bubbles built up over a certain period of time that eventually need to correct and reprice. And look no further than the FANG stocks, the semiconductor stocks, the plays that everyone are betting are just going to continue to be the best plays out there on the market. Now, I'm not a bear on technology. I love these companies and some of the things that they've built. And yes, they have expanded massive revenues over the past decade. But the question is, and this is always the question you need to ask, whether it's stocks like, Nvidia, Microsoft, any other kind of names out there, Facebook or Meta, Apple, all these names, and even altcoins and cryptocurrencies, is whether or not they can continue to grow in adoption. Equity valuations, the premium that people pay, a huge part of equity valuations is all around that question of growth. Because if there's no growth, at that point, a company has simply stalled, and it's never going to get any better from that point on. Or its growth rate is so minimal in the broad scheme of things that it doesn't make it a market leader, it doesn't make it attractive to own. So we need to keep that in mind. We'll come back to that question, but we need to take a look at the fact that 7 major companies, we're talking about Microsoft, Apple, Amazon, Nvidia, Alphabet, Tesla, and Meta, or previously known as Facebook, these 7 stocks here own over 24.2% of the S&P 500 and over 51% of the NASDAQ. This is what's known as a concentration of equity value into a select few stocks. And if we look back at history, look back at the dot-com bubble during these periods of time where technology really led the way and exacerbated itself away from the S&P 500, we see this play out time and time again. Microsoft was one of the plays back then. I think Amazon might have been as well, but you had all these other major technology stocks, Cisco, these companies that we thought at the time were just going to continue to rule the world. Now, I will make it very clear that I understand technology stocks today are much more established. They are revenue generating. They are cash positive in many ways versus back during the dot-com bubble. I'm not saying history is absolutely repeating, but it has certain rhymes. It continues to repeat throughout history. And again, this concentration of equity value, right? As we can see, if we just take a look here, this is a really nice chart that just visualizes the market share of Apple and Microsoft combined. Notice back here during the dot-com bubble, we're here in 2008, there's always generally a significant drawdown in these companies after these expansions. And boy, have we been through a rapid expansion here for these stock plays. They now own, yet again, like they had back here time and time again, around 13.3% market share. Now, I'm not saying Apple and Microsoft are terrible companies, and yeah, I understand why a lot of people would initially go to these stocks as defensive plays, as just defensive technology plays, as they are pretty cash rich. But the question is whether or not they are priced in to stomach a recession, and whether or not they've got the growth potential to continue eating up more equity value share in the market, right? Now, again, this is an important question because if we take a look at the index performance of Meta, Amazon, Apple, Microsoft, and Google, pretty good bunch of those stocks we just looked at, right? If we take a look at their performance versus the broader S&P 500, we can see that they play a big role in determining whether or not equities are going to move up over the next year or so, or really over the next couple years, whether or not we are really going to formulate another bull market, right? Because the S&P 500 is telling us there's no market leaders right now. If the S&P 500 is moving like this, right, we're looking across the board. Energy was doing quite good for a while, but generally the broader stock market is, neutral. It's worried about the future state of things. It's not ripping higher. All we have are these few technology plays that have swallowed up a lot of the Nasdaq, swallowed up a lot of the S&P 500 that are really still holding up. And then we need to ask ourselves this, right? When we take a look here at the FANG index, which again is pretty much where it was back in September of 2022, very far away still, right? Almost moved down about half here from the previous all-time highs in November, right? We need to ask ourselves whether or not we've got not only the momentum here in price for another bull run in these stocks, but more importantly, what's the narrative? What's the growth narrative that's going to get us excited, right? And that's a very important question. I really want you guys to think about that for a second. Each and every bull market is driven by a narrative. And in this case, for the FANG stocks, they expanded during a period of time of the mobile phone, the expansion of Web 2, which allowed through JavaScript and all types of programming languages to build exciting mobile and web applications that allowed us to do exciting things, allow us to interact through social media, through content platforms like YouTube, all kinds of incredible innovation. Digital advertising that allowed for the base monetization of these platforms. Just allowed for incredible things, advancements in semiconductors, right? And I'm not here to say that over the next 10 years, we're not going to be in a better place than we are here today. I'm not here to say that, guys. But I need to ask you guys, in the next year or two, what do you think is weighing more on equity prices? Some really exciting narrative or recessionary pressures? What's weighing on investors' minds here? What are we more likely to correlate towards? Some exacerbated future potential, which usually takes a decade or more to play out? Or are we leaning more towards recessionary pressures? I think we're going towards the latter. I'm not trying to be negative. We've ridden the bull market the last decade, but we got to know when the music has stopped. And to be honest, a lot of these technology companies in the FANG mix, as well as some of the other larger players outside of the FANG acronym, they're not doing too much innovation. What is Meta really achieving here? I understand they're looking at doing the VR, augmented reality, headsets. I understand that could become a really solid business long term, but is that really the bet you want to go on into a recessionary environment? How many of those products are really out in the market generating significant portions of Meta's revenue? If anything, it's burning cash flow. And if anything, Zuckerberg is stepping back and laying off employees. Now, while that may be a smart move in a recession, it might be the proper thing after hiring an exacerbated amount of people during the pandemic. As business starts to slow, it's not what's going to drive another bull market. Layoffs do not drive growth. They cut costs. They signal that a company is going into a defensive position. So it should start trading as a defensive company rather than some high growth stock, right? So this is again the catch-22 here. Facebook or Meta does not get rewarded for innovating during this period of time, and it also doesn't really get rewarded in its equity value potential when it lays off employees. All right, so that is not looking good here, right? Amazon, what is Amazon going to do during this period of time? What can it really innovate on? It's gotten mass adoption here. How could we ever see more growth potential in its base, basically shipping business of shipping goods to various different homes across the country in the U.S. and global markets? How is it going to get any better than when everyone was locked down, when everyone was forced to use e-commerce? Is Amazon Web Services going to come in to save the day for them? Well, it's gotten pretty broad adoption, and the growth rate over the last couple quarters has been slowing dramatically. So Amazon doesn't look very good. Well, how about Netflix? Well, Netflix is at the point where they're starting to go after people who have too many accounts, or more specifically are using too many accounts on one login, getting more people to try to subscribe and create their own accounts. This is a very bad sign. This is a sign that Netflix may be in its dinosaur phases as a company. Essentially, it's getting to the late stage where it hasn't been able to diversify its business model. And now it's going to start looking at paying a dividend and starting to slowly leech off of the existing user base that it has. That's not a good sign either. And Google. Well, Google, again, does have strong advertising revenues. It's got a great base of products, but outside of advertising, Google doesn't generate revenue in many other places. Maybe in its cloud business, sure, but again, same situation as Amazon. So these companies, the majority of them, are not innovating, right? Facebook's core business model, again, back to its social media platform, they're trying to copy TikTok. Great. Do we have anything breakthrough? Do we have a new iPhone? Do we have anything that we can really hold on to? Well, there is one narrative. And there are a couple of these companies that we talked about that are overexposed in these areas to benefit. And that's why they've been performing and breaking away from the broader FANG stocks. And that is Microsoft, Nvidia, and Tesla. Now, Microsoft having a huge ownership in OpenAI, the leading company that created ChatGPT and some of the really exciting technologies like DALL-E and AI-generated text and imagery. This company has been leading the way because they have a large stake in OpenAI. So if people get more optimistic about AI, Microsoft is going to move higher. That's why Microsoft's at its highest level since back in August, and it's well suspended above that 200-day moving average. Nvidia as well has deviated quite broadly away, right? It's made about a $100 move in its share price since back in January, breaking well above its 200-day moving average to its highest price point in April of 2022. The reason being, there's a lot of GPUs that are going to be needed to facilitate all this demand for utilizing systems and tools like ChatGPT or DALL-E or Midjourney, all these AI generating services. So these are the narratives, and also as well, you've got Tesla, which again is chopping between its 200-day, its 200-week here, still holding up where it came back in February from those lows, pretty much doubling in share price off of the lows. And that's got a lot of people thinking that Tesla's going to rip higher. Why? Because Tesla, with Elon Musk and the talent they have, could very well be a player in this AI space as well. They've already stated that they're working on some different types of technologies. Anyways, I digress here. The question is the AI narrative enough to carry these companies forward? I'll tell you guys this, I'm working on like a small passion project within ChatGPT right now. And I gotta tell you guys, I'm really excited about the technology, right? It's not perfect. It's not this artificial general intelligence that is above human capacity, just gonna do this absolutely amazing things and is gonna, just take the world by storm, right? We're not there yet with this technology, but I have to say as an AI skeptic, this is definitely the most useful tool in AI, and it has taken the narrative around AI to a much higher playing field of maturity and actually being able to disrupt things, being useful and building things, that all being realized. As much as I have to say it is definitely a really exciting tool, it is not enough to save these companies. It is not enough to continue driving Nvidia's demand to where it can be valued at a 151 PE multiple, or for Tesla to be valued as an automotive company at its core business model at a 52 PE multiple. We cannot continue to ignore these type of PE multiples going into a recession, because in a recession, those multiples will drop significantly. And if the multiples are dropping significantly, that means the share price is likely going to be heading down with it. Now, here's the big thing overall. Here's the big catch, right? We know that OpenAI really has dominant market share right now in this industry. And there will be Bard, there will be all these different competitors. Bard is Google's AI competitor here, one of the few areas that, again, might put Google into that camp of leading in the AI innovation wave of things. But I want to go ahead and just talk about this. This metric here signals everything. That ChatGPT owner OpenAI is expecting that they would have about $1 billion in revenue by 2024. So let's think about this here, right? We need to talk about this in the sense of the financials. $1 billion in revenue by 2024. So not by the end of 2023, by the end of 2024, OpenAI is expecting to make $1 billion in revenues from its services. Now, this prediction was coming out back in mid-December. Perhaps, maybe it's going to be $2 billion or $3 billion. Either way, even if it's up to $5 billion, is this really enough to generate enough excitement for the broader technology sector? It's definitely a sign that there is a new market here. AI and AI services are going to be huge over the next decade to come. I get that. But I got to tell you guys, this is just revenue. It's not profit. It's not something that's going to be looking good for Microsoft to be eating up all the costs that are going into facilitating these services into a recession. And that's where innovation, albeit while it may be an exciting thing for the future, is a net negative going into a recessionary environment where the economy is slowing, where risk on assets underperform. Burning cash is not good because that eats into Microsoft's other potential profit that it could pass on to shareholders. That can help it bolster and protect itself during a downturn. Like I said, I'm very excited about the AI narrative, guys, but it's important to understand these dynamics and to understand that innovation takes time to play out, right? ChatGPT and other technologies like it are very exciting, but we need to understand that at the end of the day, it does not make these companies immune from their core businesses getting hurt during a recession where there's weaker consumer confidence. And all the other business sectors that Nvidia, Microsoft, and Tesla rely on. If people stop buying Tesla cars at the same pace they're doing now, and they don't meet to the rapid expectations that they have for the next couple of years, that's going to be a bad look. That's going to make share price go down. Same with Nvidia graphics cards. There is definitely demand from AI, but is it going to be enough to come up for all that demand and continue pushing equity valuations higher? I don't think so. Now, one last thing I think you guys should focus on is the defensive plays. What's going on in the Dow Jones. And this is probably your biggest telltale sign of a recession. We are almost exactly repeating what we saw back in the 2000s. The Dow Jones generally outperforming the broader indices as it was one of the defensive plays with high dividend yields and allowing people to fight, basically kind of find some safety, some place away from the more risk-on plays in the market. Well, since back in November, this indicator, or more specifically this index, has been moving lower. We're at the lowest price point since back in October. And yet again, if we just turn off our drawings here, we can see that this looks heavy, overweight, and it looks like it's ready to move lower. Now, if we look at some of the bigger stocks that go into this indicator, or this index, apologies guys. See, I'm rambling too much today. I think I need to take a sip of water in a moment. But as you can see, if we take a look, we're going to take a look at three key stocks here. You've got Johnson & Johnson, which has been down for 4 consecutive months after already setting in its highest price level back in April of 2022. Since then, it's been stagnating. Is now trading suspended below the 200-week moving average. Now, over the last decade, when we did this, when we came below here, it was a quick dip. Buyers bought it back up and drove us back above the 200-day within a matter of 2 months from revisiting back below that 200-week moving average. Well, this time, we're not doing that. We're having a nice slow fade below there. This is becoming the new norm. And what happened last time when we did that? We had 08, right? And what happened the other time that happened as well? Well, it was 2000, albeit we were much more suspended as it was a higher growth period for a conglomerate like Johnson & Johnson. But again, I think using 08 here as a model is much more fitting. Essentially speaking, we're going in for a typical 35, 40, 45, 50% correction in names like Johnson & Johnson. And that dividend that everyone's relying on, that 2.99% dividend, well, basically, so far here in the month of March, we've almost faded in the base principal losses, any of those dividends. But if you bought last month, or if you bought the month before that, The losses you're facing from the principal are not being made up by the dividend. So this is why the narrative of dividend stocks, oh, it's going to save you, the dividend's going to be great. Yet your base principal is bleeding from when you bought it. And sure, maybe the stock price will come back up one day. Not saying that it can't, but a lot of these companies eventually get to a stage where long-term they don't make new all-time highs and they continue to bleed out versus their dividend. And you'd be better off just being in cash and waiting for the signals from market leaders. Again, another play here, United Health Group, huge healthcare conglomerate, largest one in the United States, has been down for a consecutive 5 months. And while we haven't gotten down to the 200-week just yet, it's looking like it's steadfast forward after breaking the 200-day. And if we look back at 08 as an example, you can see that these names, which usually move straight up and to the right, are the ones that bleed very heavily. And again, a lot of people talk about the dividend, 1.4%. Well, we pretty much lost that already in the month of March. So again, this narrative of chasing the dividend stocks just doesn't work. The defensive plays. Pfizer as well. Like, I don't even want to talk about the vaccines and stuff like that. But just look at it from a chart perspective, no matter where you stand on it. Peaked out back in December 2021. Failed to maintain above the 200-day after the rebound off the 200-week. This looks disastrous. This looks like it's going to bleed out for a couple of years. What narrative is going to get people excited about Pfizer as a company? They've got a lot of issues they're dealing with at the moment, and they're going to continue to face issues with unfortunate bets on one particular business product that is continuing to give them more pain now than good. So I'm just going to tell you guys, I think all of these companies, these big conglomerates, are not going to be your defensive plays. I don't think the technology stocks are really going to be that bet that you want to put all your capital into at these valuations. And this leads us back into talking about crypto. It leads us to talking about the core reality here, which is that while crypto may have some nice relief rallies, the vast majority of valuation in crypto comes from speculation. It comes from people having excess money and needing a place to park it. And if people aren't going to have more and more excess money over the next decade, or not really that long, but over the next year or so, can crypto really continue moving higher? If the Fed isn't printing excess money and is rather keeping the balance sheet relatively neutral or on the broader trend tightening, if we can't get a continued ramp up in QE after this recent bump we saw, if it's just a small bump in the road and we're going to continue back down or keep where we're at, do we really have the fuel to kick off the next bull run? That's the broader question you should be asking. That's the realistic question we need to ask ourselves, not some hyperbolic, Bitcoin to $1 million, the entire financial system's going to collapse, we're all going to lose our jobs, and if we don't have Bitcoin, you're not going to be able to buy food or pay for your shelter. I mean, really, guys, that kind of narrative is the same kind of reckless stuff that, as we talked about before, when people are telling you to go leverage long on Bitcoin in order to make back for losses and become a millionaire overnight. I'm sorry, I don't have $1 million to put on the sidelines and bet that Bitcoin is not going to go down to, it's not going to go to $1 million. And no, I don't have referral links to promote you guys to go out and make some crazy trades on leverage trading exchanges. I'm just here to be honest with you. I want you guys to make smart decisions, preserve and protect your capital, and not think about what you can make, but what you can afford to lose. Because if you can do that, if you can keep coming back here to the channel, if you can tolerate my rambling and continue to dive in through all the charts and resources we have, and you can wait for that real capitulation event, not just in crypto, but in the broader asset markets, it's going to pay big dividends for you guys. I can guarantee you that if you can wait for that moment. Okay? And if you want to have some exposure, you want to have a little bit in Bitcoin, buy some of these tech plays, kind of ease a bit of the FOMO, make sure you got some exposure, sure. Be my guest. That's totally fine. I'm not here to be an absolutist and say you got to be all in cash. We've got a couple of our crypto positions we got exposure to, but it doesn't mean you need to go all in. That's the only narrative I want to share here. And if you guys enjoy this video, if you enjoyed it, definitely consider dropping a like. Consider checking out some of the resources we've got here, like the Dash Report. If you like this kind of content where you guys can get exclusive market updates, you get our monthly newsletter, over 20 pages of macro analysis on crypto, equities, the broader commodity and FX markets. And on top of that as well, you get to join the discussion group where you can chat with other Dash Report members. So many other resources available, so feel free to check that out. But until the next video, everyone, thank you all so much for watching. Thank you for letting me ramble, and I'll see you all in the next video. Take care, everyone.